Hi everyone, welcome along to the Squirrel webinar. We will talk today about Squirrel, the company. We'll talk a bit about the OCR, which is announcement, which is due tomorrow from the Reserve Bank of New Zealand. And if you're watching this later recorded, you'll see whether our predictions have come true or not. We'll talk a bit about the property market, and there's a particular section on Auckland and the unitary plan and what's happened there over the last 10 years or so. We'll then move on to a bit about what's happening in defaults across the market, and then how Squirrel's reserve funds support you when a loan does default. Last but not least, we'll move into Q&A. So this morning's Q&A, or this afternoon's Q&A session went for a marathon 45 minutes, I think the longest ever. So I'm expecting some amazing questions from you all this evening. As we go, don't be afraid to queue up the questions so that when we reach it, I can rip straight into them. Otherwise, we'll end up with a pregnant pause and no one wants that. Alrighty. I should also mention, if you have feedback on what you hear today, don't be afraid to let me know. You can email me on dave@squirrel.co.nz. So very open to feedback. Thanks, team. I'll be talking for about 20 to 25 minutes and then we'll move into the Q&A session. Wonderful disclosure statement. You can go back and read that once we publish it on YouTube, which will be in about a week's time, if you really want to get into the details of that. Starting with Squirrel, the company today. So we're all about making finance fairer. It's our purpose. And the way that that plays out, so I've given a few examples on the page here of what we do and how that works as far as trying to make finance fairer in New Zealand. First of all, we try and give you really granular access to investment options that are priced fairly. You can argue whether the banks do a good job of pricing fairly for investors and borrowers. In our view, we think we do things fairly. From a lending products perspective, we risk-based price. So that means if you're a higher risk borrower, we'll charge you more. We'll put more into a reserve fund as a consequence of that. If you're a lower risk borrower, that means you pay a lower price. So we think that's a healthy thing, another way of how we make finance fairer. It's not also just about the price though. If we look at the lending propositions that we have put into market, and the investor propositions, we've really tried to find niches where other players don't do a great job. And so we have better options available for that group of borrowers and investors. As many of you will know, we have a large team of mortgage advisors. So they offer mortgage advice, and that helps borrowers make sure they get to the right lender. Different lenders have different features in their products, different prices. Sometimes they're in the market, sometimes they're out of the market. Our mortgage advisor's job is to help them get the right deal for them. Not only that, they also then provide choice. So there's a range of lenders in our panel that our advisors can help set up loans for. We'll also have an opinion. We'll point out the good and we'll point out the bad when we see it in the market. So for those of you who have come across David Cunningham, our CEO, and John Bolton, our founder, neither of them are shy in saying what they think. In fact, David Cunningham's put out a post today talking about why he believes that the Reserve Bank should not move the OCR tomorrow. So we'll see what happens tomorrow on that front. From a dimensions perspective, so Squirrel is a New Zealand owned and operated company. We've got a fully independent board of directors as of 1 April this year. Prior to 1 April, we had independent directors, but it wasn't a fully independent board. We have 150 people or thereabouts working for Squirrel across Auckland, Wellington and Christchurch, a couple of others scattered into other locations like Dunedin and Tauranga. Last financial year, so that ended 31 March for us, we advised on $3.5 billion of loans in the residential property market in different ways, shapes and forms. So that's starting to get to a meaningful number. That's a lot more than some banks, smaller banks will originate in a year, that's for sure. We look after 700 million of investors' money. That's both in the Squirrel On Call account, in our peer-to-peer term investments, and in our suite of managed funds. If you want to find out more about Squirrel Money, so that's the entity within the Squirrel group that looks after investors' funds and lends out to borrowers, we publish our financials on the New Zealand Companies Register. So if you head over to the New Zealand Companies Register, search for Squirrel Money, you can go and have a nosy at those if you wish. The FY26 financials should be published in the next 10 days or so. So keep a watch out for that if you're that way inclined. All right, that's a bit about Squirrel, the company. If you have questions on that, don't be afraid to pop them in the Q&A box. Let's talk interest rates for a moment. So OCR announcement from the Reserve Bank tomorrow. If I pop to the box on the right-hand side here, market pricing this morning said there was a 72% probability of an increase in the OCR tomorrow. So the market's not fully convinced, but reasonably convinced that an increase is likely to take place. If we look out a bit further, the market's pricing over 100% probability of two 25 basis point increases by Christmas. So the market's hedged its bets and said there could be two, there could be three. However, market overall is saying interest rates are likely to rise during the course of the year. If we look back to what happened at the last OCR announcement, Dr. Anna Brennan, who's the Reserve Bank governor, made the casting vote. So there are 7 people on the board that effectively make that decision. 3 voted for an increase, 3 voted to hold rates where they were, and Dr. Brennan played that casting vote and said, no, we're going to hold for now. So what's changed since the RBNZ made that decision about 6 weeks ago? So first of all, Middle East war is now, shall we say it's on hold? I don't know. I'll let you interpret the headlines. Broadly speaking, on hold. We've seen fuel prices come off a long way since that. In fact, they're at a crude pricing level almost back to where they were prior to the war breaking out. The primary sector in New Zealand remains really strong. So dairy, for example, red meat prices are really strong. We've seen kiwi fruit prices being excellent this year, and an exchange rate that's relatively low. So those exporting primary sector businesses are actually going pretty well. On the horizon, though, we've also got an El Nino forecast, which often means drought in different parts of the country, particularly eastern side. Business confidence has been improving, but it's been off quite a low base. So I'm not sure I can read too much into that to say businesses are stoked across the country right now. Consumer sentiment is also pretty weak. Has bounced off its lows, but still remains pretty weak. And the housing market in most of New Zealand, but certainly not all of New Zealand, remains pretty cold. And that's both from a prices perspective and from a turnover perspective. We've also seen home loan rates head upwards, and then very recently, so in the last week or so, we've seen some rates cut. But generally speaking, home loan interest rates are higher based on where they were 6 weeks ago. Unemployment is flat at the moment, no signs of it dropping. And I think if we look at the past Reserve Bank interest rate cycles, they've tended not to drop the official cash rate until they've seen that unemployment rate actually start falling. It hasn't fallen at this point. It's still sitting at 5.3, 5.4, around there. Last but not least, inflation is definitely higher than what the Reserve Bank forecast at the beginning of this year. However, if oil prices do come off, and there is some forecasts that I've seen recently that said they're going to come off quite a long way, it's possible that we could see a much lower inflation rate during the course of next year and get back to our midpoint, almost regardless of what the Reserve Bank does. So interesting there. Will the Reserve Bank look through that or not? We'll find out tomorrow afternoon. The other thing on the horizon is there's an election in November. We know the property market tends to quieten down in the run-up to an election. We also know that the Reserve Bank tends not to move the official cash rate in that 6 weeks before an election actually takes place, try not to influence things overly by in the economy by moving that rate around during that election race. So that's another factor that might weigh into the Reserve Bank's thinking as to whether they get an increase in earlier and then perhaps one at the end of November or early December, whenever that OCR announcement will be later in the year. So something to watch out for there. As I said earlier, our CEO published today saying his view is the Reserve Bank should not increase the OCR. So we'll see. We'll see tomorrow. Moving on. So what's going on in the residential property market? You'll see the graph on the right there is the house price index, which shows the green and grey lines, which are Canterbury and the rest of South Island, since January 2023 have actually performed pretty well. So prices are up, not up dramatically, but certainly stable and rising. Compared that to other parts of the country, so if we look at the North Island, particularly Auckland and Wellington, those markets have been weak on the price front. One of the other things that we saw during March was that properties didn't sell, which flowed into lower settlements in April, May, and perhaps a little bit in June. So March and April were very soft settlement months for the residential housing market in New Zealand. But we did see that starting to pick up a little bit again now. Winter tends to be seasonally a little lighter from a transaction perspective. The election, as I said earlier, 3 to 4 months out tends to mean things go a little softer. The spectre of a capital gains tax might well keep investors on the sidelines. Great time for first home buyers to jump in. The upshot, I guess I said at the start of the year, my expectation was that we would be through the tail end of this property cycle by the middle of this year. The war in the Middle East, I think, has hampered that. And now I think with the election also in the mix, we're not really going to see the end of this cycle until Christmas. That doesn't mean that the market is dead. By no means is that the case. There are still properties selling. People are still buying. Prices will remain a bit subdued, particularly outside the South Island, over the remainder of this year. All right, so that's the squirrel view of what's going on in the residential housing market right now. Very recently, I saw a presentation that was put together by Auckland City Council's chief economist. I didn't even know the Auckland City Council had a chief economist, so I learned something new there. But it talks about supply and demand in the Auckland residential housing market post the unitary standards changing about 10 and a half years ago now. So there's a really interesting series of graphs which I'll walk you through relatively quickly. So first of all, what's changed since the unitary plan was introduced? And what you can see there is a massive increase in the volume of townhouses being built in Auckland. That's represented by that goldy colour in the graph. Everything else is relatively stable, hasn't changed a great deal over that period, but certainly townhouse volumes have increased substantively over that period. So, townhouses now make up about half of the new building consents that are going through council, give or take. I suspect that number will continue to increase, and we might get to a sort of a 60-40 ratio of 60% townhouses, 40% everything else as we go. Since the unitary plan was introduced, if you look at the volume of houses being built relative to the size of the population, pre the plan being introduced and post the plan being introduced, you can see a lot more homes are being built relative to the size of the population. So that's represented in the bar graph on the left-hand side there, and contrasts Auckland's position with the rest of New Zealand, with the Wellington region. It also contrasts it with what's gone on in New South Wales and in Victoria and Australia, just for comparison's sake. So you can see quite a substantial uplift there. So what happens when you change the zoning laws and you allow for higher density? All of a sudden, you've enabled supply to take place, and take place it has. Where have all those houses been built? So this is the distance. This chart represents the distance from the city centre about where all those new houses have been built, particularly the townhouses. You can see they've been built predominantly in suburbs close to the Auckland CBD. So I don't know whether they've just drawn a radius or whether it's by road, how far that is. I'm assuming it's a radius. But you can see virtually all of those new houses have been built within 15 kilometres of the city centre. For me, I cycle into the city centre every day. That's about 15 Ks. So, most of those houses have been built within cycling distance. It means that our public transport works better. A denser city close in around that CBD makes for easier planning for the councils. including things like three waters. It makes life easier for the electricity providers. All of those things make life tends to be easier when things are denser, and we tend to end up with better services. That doesn't mean it's easy. It's easy, infrastructure's still got to get built to cater for that population. But if you can make it denser, it does make it easier to provide those services. All right, this is the last chart in the series that I'll present around the Auckland Unitary Plan. So this looks at the rents that are charged across Auckland, New Zealand, and Wellington. So since the Unitary Plan was introduced, you can see Auckland has undershot rental price increases compared to the rest of New Zealand and compared to Wellington as examples. Um, is that a good thing? Well, if you're a landlord, you might not think so, but if you're a renter, which about half of our population are, that's a fantastic outcome. So, increase in supply has managed to hold rents lower. Landlords are still buying properties, so, that supply and demand balance is better. And as a consequence, it's probably a better outcome for the renters of New Zealand. It also means a lot more choice that they have on the type of property that they are wanting to go into. All right, there you go. There's a view on the Auckland Unitary Plan and the implications of that for supply and demand in the housing market. Moving on now to the reserve fund support for what happens when a loan defaults. So I'll start off this series with a look at what's gone on at a market level. Okay. So what you're seeing here is Reserve Bank data, which has been collected since late 2014 on the size of loan books. We've got an indication of the amount of revenue that the banks are making, and then the size of the write-offs, net write-offs that have occurred in the housing market. Okay, so that's what we're looking at. Let's start with a chart on the left. So the blue bars represent the size of the pool of housing debt in New Zealand, which is approaching $400 billion. Okay. I think this is as of December 2025. So the number was about 380 something billion. And today that's got very close to 400 billion, but not quite there yet. The green line represents the amount of revenue that banks generate off their housing portfolio. So we've assumed that the banks are making a margin of about 1.5% on that, which generates revenue of about $5.8 billion. So 5.8 with a B billion. Chart on the right-hand side looks at the net write-offs. So what does a net write-off in housing mean? That means the bank has gone and sold a property and a loss has occurred. So if we play that out by way of an example, let's say it's $1 million house. The bank had lent 800,000 on that property. The borrower then defaulted. The bank then went to mortgagee sale and sold the property. And let's say after their real estate costs and legal fees, the bank only gets back 700,000. So they lent 800, they got back 700. That means there's a loss of $100,000. And that's what a net write-off is. It's that net loss that the bank's taken. So the chart shows for each of the years from 2015 through to 2025, the value of those net write-offs. Okay, so the peak number was 2015. Remember, that's still kind of tail end of the GFC at that point. The banks collectively wrote off 57 million. That's with an M, not billion. Wrote off $57 million. You can see in 2021 and 2022, when house prices went through that significant run up, the banks collectively lost 4 million in 2021 and 5 million in 2022. So when you compare that to the revenue that they make of, let's say $5.8 billion today, it's a rounding area so small that you almost can't measure it. On the right-hand side of that right-hand chart, it compares the size of the housing portfolios to the loss that's been taken. Okay, so that pink line is what you see representing that number. At its peak, it was 3 basis points, so 0.03%. It bottomed at virtually zero in 2021, and today stands at 0.007%, so a few zeros in there. So very small levels of write-off. What's going to happen in 2026? So we have one quarter's worth of data for 2026, and there was 11 million written off collectively by the banks. So are we expecting 2026 to be higher than 2025? I would say at this stage, yes. Will it reach the highs of 2015 that we can see in this chart? Highly unlikely would be my view. I think the housing market's kind of found its equilibrium. Most borrowers have got back on top of their debt. You can see that in the Centrix data that's published on a monthly basis. Housing portfolio arrears are kind of back to normal, broadly speaking. So my view is while we'll see more in net write-offs in 2026 than there was in 2025, it's highly unlikely to get to the 57 million that we saw in 2015. After all of that, let's remember a couple of things. First of all, property prices are down 15 to 20% from their peak, depending on which part of the country you look at. Auckland and Queenstown haven't quite climbed back to their peaks. Queenstown Lakes is almost back to where it was, but not quite yet. But generally speaking, across the country, property prices are down 15 to 20%. So the banks are taking losses that are very small despite a significant drop in property prices. That's really important because that loan to value ratio is a really important indicator for lenders. If you inflation adjust those property prices, they're actually down 35% or 30 to 35% from their peak. I think Wellington's down 35%. That's pretty substantial. So, in theory, if you've managed to secure some pay rises with inflation over the last sort of 4 years or 5 years, actually, houses have got cheaper. Happy days on that front. All right, let's keep moving. So here's a bit about what Squirrel plans for relative to what we see in the market. So I'll try and talk you through this table that we have here. The first column of data is the market for home loans. So it's the annual arrears outcome that we saw, or annual arrears information, I guess. So in that first cell, in that column titled Market Home Loans Annual Arrears Outcome, the peak observed defaults in 1 year was 0.03%, and that was in 2015. Okay, and remember that's for the market. If I walk down the table, the banks collectively had provisions, that's individual and collective, and I can answer questions on that if you're not sure what that means later on, of 0.23%. So that's the bank storing money on their balance sheet in case loans go bad. So, you can see that they're effectively reserving quite a lot of money relative to the peak that we've seen in the last 11 years for things to go wrong in the housing market. Banks don't publish what their calculated portfolio risk is. I'd hazard a guess that it's about 5 basis points or 0.05%. Not too dissimilar to what Squirrel's home loan portfolio looks like. Last but not least, the size of their provisions is 883 million. So what does that 0.23% factor to once you look at the size of the loan book? It's about 800 let's call it 900 million that they've got reserved on their balance sheet for loan losses to come through. Okay, so how does that contrast with where Squirrel's at? And I think the next two columns talk to Squirrel's home loan portfolio and Squirrel's construction loan portfolio. So what's our peak observed defaults? So in our home loan portfolio, we've never had a loan default. So there's actually no data. The answer is 0%. We've written around about 250 million worth of loans, maybe it's 270 in that zone somewhere, not had a loan default at this point. And therefore there can't be any losses that we've seen. If we talk to reserving for our home loan portfolio, and this data is at December 2025, so it was comparable to what the banks were doing at that point. So I should have mentioned that at the start, sorry. So this is going back 6 months to December 2025. Reserving was at 0.54%. Okay, so we're reserving at a pretty healthy rate. It's about double or a bit over double what the banks were reserving in their home loan portfolios at that point in time. And then how big is our reserve fund? So reserve fund at that point in December was at about 600,000. Today it's closing in and almost at 800,000. So that's what we've got sitting on reserve in the event that a loan goes bad and a loss results. Remember that a loss won't always result when a loan goes bad, because let's say it was $1 million house. If I use that same example, we'd lend 800,000, we go to mortgagee sale and we manage to sell it for 850. Once we take off the legal fees and the real estate fees, it's likely that we would still get fully repaid on that loan. All right, so let's look at the construction loan portfolio. As you've heard me talk about before, the construction loan portfolio carries more risk, which is why you as an investor earn a higher return when you invest in that construction loan portfolio. So peak observed defaults. Now, I've actually given you this as the total amount that we've lent, less the total amount of losses that have taken place, or as a ratio. So we're at 0.06%. Is the observed default. So we've had, this is as at December, we'd had 3 defaults at that point. If we contrast the size of those net write-offs with the size or the volume of loans that were written over that period, it worked out at 6 basis points, or 0.06%. In December, we were reserving at 0.76%, which was a pretty healthy rate. It's definitely a step up from where we are in home loans. Our calculated portfolio risk, we've deliberately increased or adjusted our model and increased the amount of risk that we think is in the portfolio based on the fact that property prices have fallen a lot from their peak. Now, our loan portfolio is relatively fresh. This is us being conservative in the way that we're thinking about our portfolio. So that's why you see that calculated portfolio risk up at that level. I suspect you'll see that come down as we go through the rest of this year. Remember, that was as at December. Interestingly, the peak of the arrears in our portfolio and overterm loans was in October last year. So I suspect we're mostly through the worst of the cycle from a Squirrel perspective. A little bit further to go, as I pointed out in my recent update with a couple of mortgagee sales that'll take place. Last point on this page is the size of the reserve fund. So in that construction loan reserve fund, at December, that was 4.3 million. So fair amount of money tucked aside to look after any defaults that were to come through and any losses that ensued off those defaults. From the 3 loan defaults we've had in that portfolio so far, they've averaged about $170,000 as a loss. So if that was to play out at a portfolio level and you saw more losses, each one being, in that sort of 150 to 200 zone, which is conceivable for the construction loan portfolio, there's quite a lot of dry powder there sitting in those reserve funds to manage that risk if losses were to take place. The obvious question there is, well, why might there be more of a loss in the construction loan portfolio relative to the home loan portfolio? If I talk it through as an example, let's say we've got a half-built house and a builder is liquidated at that point for whatever reason. Selling a half-built house tends not to cover the value of the loan. And the reason is that if you're someone looking to buy a half-built home, you're not going to be paying top dollar for that at that point for obvious reasons. So what Squirrel would typically do in that situation, and this has occurred once, we were halfway through a build, or the builder was halfway through a build and went under. So we took possession of the property, we appointed a new builder who then finished the build, and then we sold the property. That was the way we thought we would deliver the best outcome for the reserve fund, remembering that all investors continued to receive all of their returns and were repaid all of their principal because the reserve fund did its job. Okay, moving on to the last slide here, which is what happens when a loan defaults. So I'm going to talk through the steps and talk through what happens for the reserve fund. So first of all, step 1, borrower defaults. Borrower's liquidated, like that example I gave you of a builder who's halfway through a build. They stopped paying their bills, couldn't make wages, and they were tipped into liquidation. Squirrel then initiates the process to sell the property. If it's a home loan in a typical sort of house or townhouse type situation, we'd then set up a mortgagee sale and sell the property. We'd try and do that relatively quickly because there's a time value of money there. We're still paying interest. Or the reserve funds are still paying interest out to investors. So it's in everyone's interest to get that moved on relatively quickly. And if it was a construction project, depending on where it's at, either we'd sell it as is, or we may finish it if it's halfway through a build and get it finished and then sell the property. Step 3, the reserve fund is continuing to make payments on borrowers' behalf to investors. Okay, so I'll explain that via the diagram shortly. Step 4, the property sells at, let's say, mortgagee sale. The proceeds are applied to the loan. If there is a shortfall, so that's where there's a loss. So that means that the amount that we've got back from selling the property is less than the value of the loan. At that point, then the reserve fund takes that loss and pays out to investors to ensure that investors receive all of their principal and all of their interest along the way, remembering that investors have continued to earn their interest each month because the reserve fund stepped in. If I explain that via the diagram on the right-hand side, so let's say a borrower is ticking along nicely, making their monthly payments. When they make that monthly payment, most of it goes to the investor each month, a bit goes to the reserve fund, and a bit goes to Squirrel as our service margin for looking after the borrower and making sure things tick over. To give you a sense of how much goes to the reserve fund and how much goes in a service margin. So typically a borrower in our portfolio today might be paying 7%. You as the investor are earning 5%. The reserve fund might be collecting 0.5%, and Squirrel's margin is 1.5%. Okay, so if we talk about that as a waterfall, borrower's paying 7%, we pay 0.5% to the reserve fund, 1.5% goes to Squirrel, and the remaining 5% is going off to the investor. So that just gives you an example of how that works. So each month when the borrower makes that payment, we split that payment up into those 3 portions. Things are ticking along. If we go below the green line there, so now the borrower is liquidated or has defaulted on their loan for whatever reason, the reserve fund is stepping in at that point and it's continuing to pay investors their interest on a monthly basis. Squirrel ultimately makes its service margin along the way as well, although sometimes we'll even reduce that to make sure that the reserve fund's not getting hit as we go. So in that situation, the reserve fund has stepped in until such time as Squirrel has then gone to mortgagee sale and sold the property, or finished the build and then sold the property. So reserve fund plays a really pivotal role in making sure we look after the primary risk of investing with Squirrel, which is that credit risk. So if you're investing in our term investments or the monthly income fund, the reserve fund's job is to manage that risk, or that credit risk for you. And what does credit risk mean? That means a borrower defaulting is the potential outcome. All right. Summary overall. So in Squirrel's home loan portfolio, we've had no losses and no defaults life to date. In our construction loan portfolio, we've had 4 losses that have taken place. That's as up to the end of last month. Those losses, so 4 losses on a total volume of loans written of about 1,500. So I think that ratio is looking pretty good and showing that we've got a good track record of doing the right things. But can things go wrong? Yes, they can. That's why we have the reserve funds there to help protect our investors along the way. Question from Kellyanne. What asset class does it count in for a wider investment portfolio? All right, so if you're investing in Squirrel's monthly income fund or in our peer-to-peer home loan or construction loan term investments, we would consider this fixed interest investment. Okay, so what does fixed interest mean? It means debt. So you're investing into debt. The fact that Squirrel's home loans and construction loans and the monthly income fund are all secured by residential mortgages The word mortgage, if you go back to its the roots, actually means death. If you want to get morbid on it, so if you didn't pay your loan back, actually that meant you might well die. And obviously, I'm going back a long way, and we don't do that as responsible lenders today. But yeah, debt generates interest. It tends to be regular and reliable unless a borrower defaults. So yeah, it's a fixed interest part of your portfolio. So often investors will think about the classic 60-40 portfolio split, 60% being investments in equities in some ways or shares in some way, shape, or form, and 40% in debt. So uh, what Squirrel offers to investors is in that 40% zone, which is debt related. Thanks, Kellyanne. Happy to take follow-ups on that one. Question is, has been on Invest Now seen an increase in investors in Squirrel? We have, I think it's just under 500 people that invest via the Invest Now platform into the Squirrel Monthly Income Fund. It's grown more recently rather than early days. So if I look back at how the number of investors has grown over time, it grew relatively slowly over the first 3 years. In the last 2 years or so, it's grown a little bit faster. Most investors in the monthly income funders have invested via Squirrel directly, though. So yeah, Investment Now is an important partner for us and distribution channel. And we completely recognize that if you hold your KiwiSaver or other investments with Invest Now, then it's a convenient way for you to access the Squirrel Monthly Income Fund through them as a platform. All right, question from Ronell. What percentage of the monthly income fund is currently in construction loans versus home loans? So that percentage, it moves around a little bit month to month. Right now it's running at about 75% construction loans, maybe 76, and then 24, 25% in home loans. That's our target. So it's running at about the target. And that as a return, on a returns basis, delivering you a bit over 5% per annum. We think that's about the right mix of risk and reward in that portfolio for most investors. And that's informed by what we see through the peer-to-peer side of what we do. For those investors that take a portion home loans and a portion construction loans, what we've found over time that tended to run at 25% home loans, 75% construction loans. So we've used that to help us inform us what that target should be. So when you add up a few of the factors together, we think that delivers the right mix of risk versus reward for the monthly income fund. That ratio at one point was up at about 28% home loans. The lowest home loans has got to was about 20%, but the target mix for us is about 25% home loans, 75% construction loans. All right, question from Peter. Where is the reserve fund coming from? All right, to answer that, what I'm going to do is go backwards in the presentation to this page here. So in the diagram that you see on the right-hand side at the top, when a borrower is making their regular monthly payment on their loan, so let's say they've got an interest rate of 7%, you can and let's say that equated to $1,000. Let's try and make the maths easy for me. So the borrower is making a payment of 7%, which works out at $1,000. Let's say you as the investor are earning 5%. Now I'm going to get the maths all screwed up, so just bear with me. So you as the investor are earning 5%. Squirrel as a company, we might be earning, let's say 1.5%. And the reserve fund's earning 0.5%. So we split that 7% payment or that $1,000 up into those proportions. The investor earning 5%, the reserve fund earning 0.5%, and Squirrel earning 1.5%. So that's how the reserve fund gets money. It's by all the good borrowers making their payments every month. A portion of that payment goes off into the reserve fund. Those reserve funds build up over time. If a borrower misses a payment, the reserve fund steps in and makes that payment to the investor. When the borrower catches up on that payment, they owe that money back to the reserve fund and it gets recapitalized. Reserve fund, if we kind of look ahead at how much the contracted reserves are. So if all the loans on the books run to their full term and pay the amount of reserving that's there, then the construction loan reserve fund is probably due about $1 million, give or take, in the future from those future contracted reserves as well. So yeah, that's how the reserve fund gets its money. It virtually all comes from the borrower making their regular payment and us splitting it up into the investors portion, Squirrel's portion, and the reserve funds portion. We do also vary the amount that the reserve funds get is given by the borrower based on the level of risk of the borrower. So a higher risk borrower will be paying more, and the amount that we reserve also increases. Conversely, a low risk borrower is likely to be paying a lower interest rate and a lower amount into the reserve fund. So we think risk-based pricing is important to get right in the market. Question from Sandra. When will you be introducing separate call accounts? I think there are two features that our investors that I regularly hear from investors that they really want to see from us. One is the ability to have separate buckets of on-call accounts. The second feature is joint accounts. The separate on-call accounts and separate peer-to-peer term investment accounts is something that we are building right now. It's a pretty big build for us. And I think it's going to release in probably February. I was hoping we'd get it in before Christmas. That looks unlikely at this point. So I would say we're probably looking more towards February when it will go live. If we can get it done before Christmas, we absolutely will. But it's being worked on right now. So thanks for that question, Sandra. And sorry it's taking so long to get this done. We've had to move things around. We've had this planned for well over a year at this point, so taking a while for us to get it done. But it is absolutely underway and being developed right now by our wonderful development team. Thanks, Sandra. The question was, this is a follow-up question. Kellyanne asked about, well, where would Squirrel's investment options fit in someone's wider investment portfolio? And you will have remembered that I talked about it fitting into the fixed interest category. Absolutely, that's where it is. It's not in the private equity category. Private equity is something different. So if I contrast investing in a loan secured by mortgages versus loans that may have security but are private equity. Okay, so what Squirrel does today, you invest in a loan, it's secured by a residential property. We've got really strong security in place, and that if the borrower defaults, we can go and sell the house. And most of the time, that recovers most, if not all, of the money that we've made on the loan. Private equity often relates much more to lending to a business for I'll call it business type purposes. So you could be lending to a business that operates a cool store for kiwi fruit, for example. So the security that you might have in that situation is actually the cash flow off that business rather than it being secured against buildings or equipment or those sorts of things. There could be security. There could be personal guarantees or GSAs, general security agreements in place, but typically it's cash flow related for private equity. So you're investing almost like you're investing in shares in the business in a way. That has generally a higher risk profile, and you expect a higher return for that risk that you're taking. So that's a contrast between what Squirrel does today, which is residential mortgage-backed lending and investments versus private equity, which is typically lending to a business at the risk with higher risk, which you should demand higher returns. So there is definitely a difference between lending to a business, whether it's in the form of a loan or whether it's in the form of some equity investment, which is what private equity is all about, contrasted with lending, which is secured by a residential property. So yeah, definitely lower risk with what Squirrel offers compared to private equity. A really good question, that one, and it does come up from time to time. So thanks, Kellyanne. Hopefully that answers the question. And if your financial advisor wants to give me a call, I'm more than happy to chat with them about it. All right, question from Nathan. Does Squirrel have any intention to expand on the investment options for customers or sticking with the existing portfolio options? We've got about 5 products under design at the moment. That might take us into some different lending markets, and we'll present different peer-to-peer and managed fund options for you. I would say they'll collectively roll out over the next 12 months. I'd love to make them go really fast. We've got lots of ideas and things we're trying to do, so we've also got to make sure that every time we do something, we do it properly. But I would say 12 months from now, you look back and say, actually, we have delivered a range of products that fit different risk profiles and different types of investments along the way. So, yep, got lots of interesting plans there, which we'll let you know about once we've got them closer to fruition. Thanks, Nathan. Also, a follow-up question there on joint accounts. So yes, we definitely have. I mentioned that before, but didn't tell you where it's at in the priority queue. We need to complete the work on the multiple on-call accounts and multiple peer-to-peer buckets before we can do the joint accounts work, but it's absolutely the next thing on the agenda. We're actually doing the design work for the joint accounts, for kids accounts, and a few other things in that same vein, like enduring power of attorney situations. So if you're looking after your parents' money, for example, that's under design now for rollout next calendar year. I'm not sure I can give you a date yet because we've got to get this other piece of work done, but it's definitely next cab off the wank, excuse me. Next cab off the rank. All right, let's get that spat out the right way. Thanks, Nathan. Question from Sandra. Have we considered higher risk commercial portfolio at higher interest rates? Yes, something we're thinking about, Sandra, that could well be in the mix of other products that we're thinking about. We're aware and we see opportunity to do it today. We haven't chased it. Commercial property, so lending which is secured by commercial property has a different risk profile, often has a different term associated with it. So there were both kind of credit and liquidity risks to consider there. We definitely see opportunity. We've had, I'll call it, some demand from investors for it. So that's one of the things that we're considering for the next wee while. Thanks, Sandra. Question is, are you expecting monthly income fund returns to decrease due to the removal of personal loans? The answer is no. So the monthly income fund stopped investing in personal loans about 16 months ago. So the personal loans added a relatively small amount to the overall return profile in the scheme of things. So actually, no. What the likely drivers of returns for the monthly income fund are the direction of travel of interest rates. So we expect we're at the bottom of the interest rate cycle. We expect that interest rates will start to go up during the course of this year, obviously subject to more wars breaking out and all those sorts of things. It's likely that we would be putting interest rates up should you see the OCR go up. Now, we don't track the OCR one for one or anything like that, but certainly the direction of travel gives you an indication of what to expect. Thank you. Question is, what is the gross profit margin for the business? It's a harder question to answer. The reason is that we publish the Squirrel Money entity results as we're required to do. So you can see that on the company's register. If you go have a look there for the Squirrel Money entity. Squirrel, the wider group, we don't publish those results publicly. They are published to our shareholders. So hard to answer the question around what's the gross profit margin for our wider business because we don't disclose that externally, although obviously clearly is disclosed to our shareholders. I don't know if I can easily answer that. What I can do though is give you a sense of what that service margin is. So if that was your question, so once again, using the diagrams that are on the slide that I'm sharing there, The service margin that I've indicated there for Squirrel on average is about 1.5% on the loan portfolio. So does that give you, hopefully that gives you an answer there. Question from Chris. Is Squirrel construction loans exclusive, or can they finance their build along with other providers, banks, or other investor channels? So if you're investing in our monthly income fund or our peer-to-peer term investments, we have the first mortgage. So what that means is if there is another investor providing some level of debt, it would be sitting behind Squirrel. So for a builder or a property developer, occasionally they will have a second mortgage or mezzanine type funding that sits behind Squirrel. Although most of the time there is just Squirrel with a first mortgage in place. So we do see second mortgages and things like that come through. As an investor, though, you are secured by that first mortgage and have first rights against any proceeds should a loan default and we need to go and sell it. So if you've got the second mortgage, Squirrel and our investors and reserve funds eat first. If there's money left over, then that would go to any other providers. We don't invest on a first mortgage basis alongside others for our monthly income fund or our peer-to-peer term investment. So, for example, let's say a bank has lent money to a builder. They would have done so on a first mortgage basis. So Squirrel wouldn't be able to get the first mortgage, therefore the monthly income fund or our peer-to-peer term investments wouldn't be involved in that particular transaction. Hopefully that answers the question for you there, Chris. You had 3 construction loan defaults noted in your March 2026 investor update. What caused those defaults? How long did the recovery take and how much was ultimately recovered? All right, let's think back to those 3. One of them, we got, so all 3 of those construction loan defaults, the reserve fund took a small hit on each of them. The average was about 160,000. I'm going from memory there, but give or take, so about 160,000 per deal for those 3 that where the default occurred. Of the 3 of them, one happened relatively quickly. So basically, the borrower got into trouble. We worked with them and they sold the property. A loss ensued. We have a couple of other loans to that borrower, both of which look like they're going to play out quite well. So it's quite likely that we will get a recovery on that particular loan that we took a write-off on. So that's why we talk about a net write-off rate. So if those other 2 loans do repay in full and there is additional money left over, then we're actually secured by that. And so we may actually get a repayment on that particular one. We'll know that probably by early-ish next year would be my view. So that's one. Another one, borrower defaulted. They bought the property near the peak of the property cycle. So in fact, I think that settlement of that loan occurred in October 2021, which was November 2021 was the absolute peak of the cycle. Borrower had a project that they were looking to subdivide, ultimately didn't end up going ahead. They defaulted. We sold the property and we took a small loss on that. That probably took about 6 or 7 months for it to play out from the point at which they defaulted. And that occurred in 2023 from memory. The other one was a builder that defaulted on a half-built house in Whangarei. We completed the build on that and then sold the property. From the point of default to the point of the house being sold was about 6 or 7 months. If you work through that in a very practical sense, if a builder defaults today, obviously we go and secure the property and make sure we know where we're up to on that. We would then, assuming we're going to finish it, we would need to appoint a new builder. That process can take some time. Then they need to finish the project. So often it can depend on where in the project the default has occurred. If it's at the start, obviously it's going to take longer. If it's near the end, obviously shorter. And then you actually need to sell the property if it wasn't already a turnkey build. So selling a property can take, a 3 or 4 week marketing period. Either some sort of sale process is then going on, and we're trying to look at the different options and best way to sell for the situation. And then you have maybe 4 to 8 weeks of settlement period beyond that. So, it wouldn't be unusual for 6 or 7 months to pass by from the point at which a default occurs until a property is actually sold. During that period, then investors are still earning their returns from the reserve fund as we go through that recovery process. Question from Glenn. What's the difference in percent between what homeowners buy loans and what you pay out to investors? Is it possible that returns to investors can be higher than 5%? Seems like a low return to guarantee on term deposits. So if we look at our home loans, investors today are earning 4.75% for peer-to-peer term investments. The borrowers on average are probably paying about 650. So what's that, 1.75%? We're reserving, as I mentioned on one of the earlier pages, about 0.5% on those home loan portfolio. So Squirrel is picking up a margin there of about 1.25%. So that gives you a sense of what that risk and return profile looks like. On the construction loans, interest rates on those would vary from about 7% at a low to about 8.5%, give or take. We reserve a lot more on the higher interest rates. Investors are returning about 5.25% if you're investing in peer-to-peer term investments. And then the monthly income fund overall, it's a blend of home loans and construction loans, and it's returning a bit over 5% at present. So have I answered your question there, Glenn? If not, please post a follow-up and I'll try and answer that for you. Sorry, one thing I should add on that. Banks' carded floating rates are in the high fives, and Squirrel's charging on average sort of 625 to 650. So if that gives you a sense relative to what banks are charging on a floating rate, which is what our borrowers are on, which is floating interest rates. Yeah, thanks, Glenn. Any plans to offer an on-call account with a higher return to compete with other offerings presently ranging from 2.25 to 3%? Wedge at 3%, Sharesies 2.3, Kernel 2.25. That's something we're thinking about. I won't reveal our plans at this point. One thing to be aware of is when you're looking at alternatives in the market. So there's a distinction between what Squirrel and Sharesies offer, which is when you put money into the Sharesies or Squirrel on call accounts, that money is held on bare trust for you. Deposit compensation scheme applies to that money with all the various rules, and I've talked about that in a previous webinar. You can go back and look at that if you wish. I think that was in May last year, so go back and look at that one. What Wedge is offering is a fixed income investment option. So they call it Cash Plus. Wedge is taking the money in that account and they're investing it in fixed interest instruments. So bonds, for example. I think the bulk of that money is invested offshore in good, well-rated bonds, and that's what allows them to deliver a higher return. So the risk profile between what Wedge does, what Squirrel does, is actually different in that on-call space. So I want to make sure that investors understand the distinction. I'm not saying Wedge is bad. Please don't think that. We know the team at Wedge really well, and we chat to them on a fairly regular on a regularish basis. So yeah, no issues on that front. But just make sure you look at way of how the returns are being generated for the investment that you make. Yeah. So we're thinking about that space and thinking of different ways that we can attack that, and that's some of the ideas that we have in that product mix that I mentioned earlier for things that we'll be rolling out over the next 12 months. This looks like a follow-up from Nathan in some way. I've just been set up as a property manager for my grandmother. When her property is sold, there'll be a deal of cash that will need to be set aside safely. Um, is there a way for Squirrel to facilitate that, or are you waiting for changes you mentioned? So, I guess what Nathan's describing there is an enduring power of attorney situation, where you're managing money on behalf of another person. So, we have a range of customers that leverage us for an enduring power of attorney situation today already. And the way that they do it is they set up the person as an investor. Um, we receive their enduring power of attorney documents, and we work with you. You know, if you give us a call, we can talk this through with you. And that allows you then to operate the account on behalf of that person. The process and the processes that sit around that today aren't as smooth as we want them to be, and we have plans to make that a whole lot better. I'll call it by this time next year. I'd expect we're rolling that out if it hasn't already been rolled out. So we have plans to make it better. So you can do it today, absolutely. And we have plans to make that better. Best thing to do, Nathan, if you want to talk it through, is to give the team a call on our 0800 21 22 30, and they can talk you through that. Or hit me up directly on dave@squirrel.co.nz. Thanks, Nathan. Question from Peter. What's the current notice period for withdrawals from the monthly income fund? So the formal notice period is 30 days. We do often pay out those redemptions earlier, but the official feature is 30 days. So I don't want to quote you and say it'll happen in 7 days or something like that, because that official feature is 30 days. And, underlying the loans are illiquid. And so we can't rely on paying it out, tomorrow, for example, if you put your request in today. So yeah, 30 days is the official notice period for that. Thanks, Peter. Next one. When would a customer come to you for a home loan instead of going to a bank? So typically, all of the loans that Squirrel writes, where Squirrel is the lender, have come through Squirrel advisors. Okay, so typically the customer has come to Squirrel for mortgage advice. The customer has a circumstance or situation which means it's going to be trickier to get what they want from a bank. And so often Squirrel can be the lender in that situation. Now, it's not exclusive to Squirrel. Squirrel advisors also send loans to other non-bank lenders. So it's not just Squirrel. It's about finding the right lender for the situation for that borrower. So an example would be bridging loans. Often banks aren't very flexible around that. Squirrel's got more flexibility. So that would be an example for a home loan. Sometimes it might be a business owner going through a divorce. Their financials get a bit mucked around for 2 to 3 years while they go through that divorce process. Once they get themselves back on track, then we help them refinance. They might borrow from Squirrel and get some flexibility for 2 or 3 years, and then refinance that loan back to a bank once they've got themselves back on an even keel. So those are examples for a home loan of why someone might use Squirrel rather than going directly to a bank. Increase in flexibility. Next question. What is the monthly income fund's present return based on recent months as opposed to the previous year? So it's running a bit over 5%. It's hard to advertise returns for managed funds because technically speaking, if we look at the way that the regulations are, you should only advertise the return in non-annualized terms for a month or for a quarter. But that becomes misleading and people don't know how to read it properly. So that's why we show it on our website as being what it's delivered in the last 12 months. We're aware of other providers that show an annualized return off a quarter, for example, which for the type of product we provide is probably pretty reasonable. So the actual return on an annualized basis, albeit, I'm not following the regulatory guidelines here, is running a bit over 5%, maybe 5.2, in that zone, thereabouts, at present. And I would expect it to continue to run at about that level for the foreseeable future, subject to an OCR change. So if we get an OCR change from the Reserve Bank tomorrow, we'll review what we do at that point, but it's likely, I would say, that we would put our interest rates up for the borrowers, which also means then our returns go up for investors. How often do the interest rates of return change, and is there a notice period? So, for our investors, we will give you a minimum of 5 business days notice. So, if you think about a week's notice, so 5 business days or 7 calendar days, notice before we change the interest rates on your peer-to-peer term investments. The returns for a fund operate a bit differently. We don't give you notice of changes to a fund's returns. It's a variable rate, and so it will just ride up and down over time. Um, Typically, we'll review our interest rates when OCR changes take place. That doesn't mean we will always move. So if I look from the top of the last interest rate cycle to the bottom where we are now, um, the OCR moved from 550 to 225. So that's 3.25%. Squirrel's returns came down from uh, by 2.25%. So we were 1% less movement than the OCR. And I think that would be typical. So during an interest rate cycle, we'll tend to cut the top and the bottom off as far as where we move our returns to. So yeah, hopefully that gives you a sense of that, Glenn. Thanks. Will property ever double every 7 years again? If you have a crystal ball, we'll be able to answer that one. My opinion is no. ANZ actually put out a paper looking at what's happened over the last 30 years and what might happen over the next 30 years. Their view was that the expected rate of inflation on property would fall from about 6% to about 4%. So 6% looking back over the last 20 to 30 years, and move back to about 4% over the next sort of 20 to 30 years. So I don't know, take their word for it rather than mine. My view, for a whole range of reasons, is that property prices won't increase at the same speed that they might have done in years gone by. And there's a whole lot of factors that feed into that are probably longer the time than I have here to answer that one. But it might be a good topic for me to talk to at a future webinar. Clarifying how the reserve fund works, understanding that the reserve fund money comes from the borrower's repayments, which is true. But I've noticed that sometimes before a loan term ends, the investor return seems to drop from 5 to 4.5%. Why does that happen? No, that's not true. I don't believe that to be the case. You keep earning the returns for peer-to-peer at the rate that we've told you right up until the day the loan repays. And for the managed fund, it invests in the same way and earns in the same way. So returns don't drop as you get closer to the end date of the loan. So not quite sure what's driving that. You might want to maybe follow that up with a more specific question to me directly on dave@squirrel.co.nz, because yeah, the returns that you earn, they run in peer-to-peer terms right until the day that the loan repays at the prescribed rate. And for the managed fund, it's investing just like you are, so the same thing occurs. Question from Laurie: if things keep on as they have been today, can you ever envisage a time where you determine that the reserve funds have reached a level where you're comfortable to suspend payments to them and enable you to divert this to increase in investor returns? Laurie, the answer to that is yes, that can happen. So there's a few conditions around that. Like if I use the example of our personal loan portfolio, for those that have been around a while, you know that we offered personal loans both to borrowers and investors to invest in. So today, that portfolio's got about 3 point something million of loans in it, and reserve funds at about 1.3 million. So there is an ample sized reserve fund there in that situation. Now, we're not prepared to make the change to completely stop reserving in that today. However, if you go back about 3 years, we did actually reduce the amount that we were reserving and increased investors' interest rates as we reduced the amount we were reserving in. So I guess we've got a track record of doing exactly what you've suggested when we get to a mature loan portfolio that we don't expect to be growing particularly in the future, that we could reduce the amount we're reserving, assuming that we believe that the reserves are sufficient. Key thing for all of that, though, is we want to make sure that there is enough money in that reserve fund to always protect investors. Now, obviously, we can't guarantee that, but our goal is to make sure those reserve funds act as a significant buffer to losses coming through to investors in the future, which means we want to try and be pretty conservative in the approach that we take to setting reserve levies and to managing the money in those reserve funds and making sure that it's ample to support the credit risk in the portfolios. Thanks, Laurie. Investors actually made interest income losses. So no investors make interest income losses, assuming the reserve funds are stepping in. The investor returns are going to be at the prescribed investor rate, remembering that both peer-to-peer and monthly income fund returns can vary during the course of an investment. Okay, so if you make an investment in a peer-to-peer or managed fund today, and you're getting the requisite returns that were published on the website, the OCR goes up tomorrow, and let's say we put our returns up in 2 weeks' time. At that point, the return that you're earning on your peer-to-peer term investment and your managed fund will also go up because it's variable. So we don't offer fixed returns in that space. Hopefully that answers the question. Thank you. What would have to occur for investors in the monthly income fund to receive a negative return? So for that to occur, it would mean that the reserve funds have been wiped out and that loans that are repaying or are defaulting and there's no more reserve fund money to pick up the slack there. Now, we do have the ability to call active management on a reserve fund. So if we get to a point where we forecast that a reserve fund will become depleted, i.e. heading towards zero. So, it would take a significant crisis for that to occur, but we've kind of planned for it. We can divert some or all of investor interests in order to protect investor capital at that point. Okay, so I don't envisage a situation where the monthly income fund could deliver a negative return because the reserve funds are there to back it and the ability to call active management. So could the monthly income fund go negative? It's possible, but it's unlikely because of the way that we operate the reserve funds. Thank you for that question. Been invested for literally 30 days, but the returns aren't as strong as before. Would the last 30 days count as a weak month? No. So the returns that investors have been earning have been the same since we last moved interest rates, which was in December last year. So returns have been the same. I wonder if you're thinking about dollars rather than interest rates there. Maybe email me on dave@squirrel.co.nz and I can answer that question directly for you on that one. Thank you. What would have to happen for investors to lose money? So what are the risks? So the risks of investing with Squirrel, the primary one is credit risk, and that is that lots of borrowers default on their loans. Could that happen? Well, it could happen. What is the probability of happening? It's relatively low. So if you go back to the GFC days and you look at what happened in Ireland through that period, credit risk got to about, the probability of a loss got to about 5%, which is significant, right? Remembering that if you look at what it's been in the home loan space in New Zealand since 2015, that probability of loss would be down, probably at about 0.2, 0.3%. So, that probability would have to grow significantly. And what would cause the probability for a home loan portfolio to do that? That would be significant unemployment would be the primary driver. Okay, so that would be something to look out for. In the construction space, that has more risk attached to it. The builder or property developer needs to build the thing, so there's construction risk. Then they need to sell it. and sell it at a price that does better than the amount that they've borrowed plus their other costs. So um, probability of default for a builder is higher than it is for a home loan. That's why investors earn higher returns on construction loans than they do on home loans. And then the loss given default. So that's the other side of that equation. So if a loss does occur or the borrower does default, typically home loan with a completed house and all those sorts of things, the loss given default on that tends to be pretty low. So that's the risk that we don't return enough money from selling the house at mortgagee sale to recover the value of the loan that's been made. Whereas in construction, that can be different, right? There's higher loss given defaults there. So that's the situation where you get a half-built house, builder defaults, then there's additional costs come in because we've then got to go and appoint a different builder. It takes longer to get things done, therefore interest costs grow. All those sorts of things take place, which means the loss given default on a construction deal will be higher. All right, that was a rapid fire answer to that question, but hopefully gives you a sense of it. All right. How does the managed fund have a greater yield than the term investments, considering that the fund invests in term investments? All right. So sometimes the managed fund takes on the full responsibility of a whole loan. What that means is it will earn additional fees because of that, but it also has additional costs. So there's a thing for construction loans called a line fee. That line fee is charged to the borrower because we've committed to an amount of money that needs to be made in progress payments in the future. So if you think about a typical construction loan, we've supported the builder to buy some land. Perhaps we've lent 300,000 on that. Then there's 700,000 of build costs to construct the home. The 700,000 is not paid out on day one, but we know that we've committed to pay that out as the builder requires that money on the way through the build. For that, we charge a line fee. The monthly income fund or the underlying wholesale funds that it invests via do collect line fees along the way. And that's one of the primary reasons why you see a slightly greater yield. It does mean that it holds more cash, so there's a balancing factor. So, we're a fund supporting construction loans. We have a target cash amount of about 10% of the fund. So that cash doesn't earn as much as it does in loans. But overall, those line fees certainly make a difference for the fund where it's investing in a whole loan rather than in the fractional loans, which it can via the platform. And that's one of the things that increases the yield. Occasionally, there is a loan that that our underlying wholesale funds that the monthly income fund invests into will take as a whole loan, and occasionally there is a good yield or slightly better yield on those loans, which means that once again that adds to the fund's returns, which means from time to time you'll see the fund return outperform relative to investing just directly in fractional loans peer to peer, if that makes sense. So hopefully that answers your question. What I see though over the long run is you'll typically find the return on the monthly income fund will sit a bit below the peer-to-peer construction loan term investment rate. So today, peer-to-peer term investment returns for investors are around 5.25, and the monthly income fund, my expectation is that it's going to produce a return of a bit over 5%. So remembering all those rates are variable and will rise and fall over time. Okay, thank you for that excellent question. Next question. In a loss situation, are wholesale investors treated similarly to retail investors? Any losses shared or pro rata? So if an investor is investing via our monthly income fund or our peer-to-peer term investments, everyone is treated equally. It doesn't matter whether you've got $100 invested or $1 million invested. There is no difference. We do have a small group of wholesale investors who invest in our wholesale managed funds. Those investors are treated the same way as retail investors ultimately, as far as the investments that they're making. So On our platform, Squirrel Peer-to-Peer Trustee is the lender of record, and it's our job to make sure that everyone is treated fairly. And if you think about what Squirrel's purpose is, which is making finance fairer, it's not fair that we differentiate terms between wholesale and retail. Hopefully that gets to the heart of the question that you have. But absolutely, if you're invested in one of our managed funds or in our peer-to-peer term investments, everyone is treated equally in that sense. A question from Wilson. What if a borrower faces default because of force majeure, an earthquake, or hit by a cyclone, house got written off? Key thing there isn't actually insurance. So insurance, whenever we go into a loan secured by property, we ensure that insurance is in place. And so it's that insurance that becomes the key thing where a property effectively gets written off. So that's how the loan gets repaid, is effectively insurance being paid out. In a natural disaster situation, then the Natural Hazards Commission, it used to be called EQC, now called Natural Hazards Commission, if I've got that right. They play a role. So if the land has become unusable, then they pick up that, and then the insurance company picks up the actual dwelling on the property. So key thing there is making sure that property is insured. And before we settle a loan, we need to see the insurance certificate. It's an important part of the settlement process that we have. Thanks for the update. My question is related to the monthly income fund. What is a realistic yield in the market now? So Squirrel Fund relative to corporate bonds. Okay. So if you think about what Squirrel offers, we offer you the opportunity to invest in debt. In investment circles, that's often known as fixed interest. So what is fixed interest? It could be everything from mortgage debt to a corporate issuing a bond, which is effectively like a loan. So that's investors investing into a particular company or a bond program. So, Fonterra in New Zealand, a range of different corporate borrowers in New Zealand, and the New Zealand government issue bonds. So that's them effectively taking out a loan from the investors that invest into that bond. Okay, so Squirrel's monthly income fund return, if you assume we're at the bottom of the interest rate cycle at the moment, which I think is a reasonable assumption to make, it's returning about 5%, maybe a touch more. At the top of the interest rate cycle, so the one that we've just been, the fund was producing a return at about it was almost 7.5% in some months on an annualized basis. So you've seen the returns track up and down with interest rates. And in that last cycle, it's fallen from about close to 7.5 in some months down to about 5. So about 2.5 percentage points of drop in return. But it shouldn't go lower from here. And if anything, as we talked about in the interest rate section of this update, more likely to go upwards. If I contrast that with what happened to the OCR in that last cycle, it reached 550 at its peak, and today it's at 225. So it's dropped by 3.25% over that interest rate cycle. So Squirrel's returns have not matched the OCR, but have trended in the same direction as the OCR. That's what I expect to happen in a future cycle. The interesting thing, if you're investing in corporate bonds, obviously different companies with different credit ratings will be able to issue bonds at higher and lower rates. So higher risk companies going to be issuing at a higher interest rate, and a higher quality company will get away with a lower interest rate, right? Bond returns, or the value of your bonds, will go almost the inverse of interest rates. So as interest rates rise, the value of your bond will drop. As interest rates falls, the value of your bond will rise. So the actual yield, though, that Squirrel's going to deliver over time relative to corporate bonds, or compared to investing in a managed fund that is investing in fixed interest or bonds, it's going to tend to do reasonably well. So if you look at conservative managed funds in the market, so that's across lots of different fund managers, you'll find the Squirrel Monthly Income Fund punches pretty strongly. So in data that we looked at, if you take a 10-year view on returns for conservative managed funds, then the Monthly Income Fund delivered in the top 3. Depending on who you put into the pool and look at, could be number 1. If you look at moderate risk funds, so that's lower than a balanced fund, then Squirrel is equally right up in that top sort of 3 or 5 fund managers with the monthly income fund and its return. And a moderate risk fund has the opportunity to invest in a range of things. Squirrel, we're investing in mortgages, which tend to be relatively safe, secure type instruments, as history has proven, and as some of those graphs that I showed you earlier for what's gone on in the market demonstrate. All right, that might have been a longer answer than what you were expecting, but hopefully that delivers something of value to you. All right, next question. With regards to construction loans, do you have a cap on the size of developments? Currently, you have had defaults of approximately a 200K loss. What if it was a larger development? Okay, Squirrel's thesis around this is that we would prefer diversity and smaller developments. Um, we What's our bread and butter? So the bread and butter of what we do will be a single house build or 3 or 4 townhouses. Building 3 or 4 townhouses comes at a different price point in Auckland compared to, for example, Palmerston North. So they're quite different markets. The value of land is quite different in those locations. So um, most of what we do is in that zone. Occasionally, we will go into a larger development, and a larger development for Squirrel might be 8 or 10 homes. Okay, we tend not to go bigger than that. It would be pretty rare for us to do so. Remembering that the whole reason or opportunity that we see is that other lenders were not doing a good job on that small end of the market. We think we can do a great job in that place that brings great diversity for our investors. And it means any individual going under that loss is minimized as much as possible, particularly in that construction space. As I said, in the home loan space, most of those loans are relatively small in the scheme of things. Maximum LVR for home loans is 80%, which is really important to understand. And the portfolio tends to run at about 60% LVR. Okay, next one. How do you select what agent to use in the event of a mortgagee sale? Depends on a lot of factors. We'll look at who strong agents are in that particular area. We may have already been in contact, or the borrower themselves may already have been in contact with a particular agent. So yeah, we look at track records. We also sometimes will ask 2 different agencies to give us an appraisal and view on approach, and select the best of those. So we're not wedded to any one company. We'll mix that up and match and move it around depending on agents that are strong in a particular location. And often we'll create some competition by asking 2 players to give us their views and an appraisal for mortgagee sale. Okay. You may not be able to answer this, but has competition in the peer-to-peer lending space increased with newer providers like GoLend entering the market? Uh, well, there's plenty of competition in the lending market overall. It's not just about peer-to-peer. Um, there are plenty of private lenders and other non-bank type lenders that lend in the same markets that Squirrel does. So it's not just peer-to-peer. There's a whole range of different providers out there that lend into the borrower or the lending niches that we see opportunity in. So you see organisations like Avanti Finance, you get organisations like Base Corp. There's a whole range of them out there that are lenders that Squirrel competes with. So we believe that we have a good product for our borrowers and create great opportunities for our investors along the way. And key thing that Squirrel does that other lenders that don't really do is those reserve funds. So something really important to have a look at there. When a potential borrower approaches you, is it a red flag if they've been approached by other or if they've approached other lenders and presumably been turned down? We treat every loan on its merits, and we'll look at the situation and make a risk-based call. Um, if a borrower has been to lots of lenders and been turned down, so we can see in their credit records that they've, in recent months been shopping themselves around, it tends to be a red flag, but we will treat each borrower on their merits. We certainly look at credit records from available credit data in the market to do that, both through players like Centrix and Equifax. And in the construction market, we tend to use a company called CreditWorks, who do a lot in that construction space and a good organization for us to be working with. So, yeah, if someone's gone and attempted to get a loan from lots of different places in recent times, that tends to get our credit managers interested in doing their due diligence, you could say, and making sure they work their way through that and understand what's going on for that particular borrower. All right. That looks like we've come to the end of questions that have been asked. So if you have feedback on what you've seen or heard tonight, don't be afraid to email me on dave@squirrel.co.nz. Happy to take any questions if you didn't want to ask them here. And yeah, if you have feedback on what you've seen, don't be afraid to let me know. All right. Thanks for your time, everyone. Thanks for your evening. That's the end. See ya.